Hi everyone, welcome back to Gold Rush Reporter. I'm your analyst for gold and silver, here to give you the real insight behind the numbers, trends, and moves in the precious metals market. If you want to stay ahead of global financial changes and understand how gold and silver impact your wealth, make sure to hit that subscribe button and click the bell so you don't miss any updates. Today, we're diving into a topic that's becoming increasingly urgent: the shift away from US treasuries and the rising dominance of gold in global reserves. You might be asking, why does this matter to me as an investor or retiree? Let me break it down. For the first time in 30 years, gold's share of worldwide foreign exchange reserves has surpassed treasuries. This isn't just a coincidence. It's a signal that countries are reconsidering how they store wealth. When the US prints dollars and treasuries to buy commodities, other nations can no longer safely hold their surpluses in these instruments. Gold, on the other hand, remains outside the system, immune to policy changes or inflationary pressures. Take Brazil, for example. Their central bank has started buying gold. This is a small piece of a larger global trend. Countries that supply resources to the US are starting to see that the value of their dollar holdings could erode if the US continues to issue massive debt. They're moving into an asset that has weathered every economic storm: gold. Unlike treasuries, gold doesn't need repayment, policy credibility, or fiscal discipline to retain value. It's trusted across the globe. Now, here's what this means for investors like you. If this trend continues, gold could surpass the dollar as the world's reserve currency within the next 2 to 3 years. That's not speculation. It's based on central bank behavior and the inflationary pressure from commodity markets. As gold climbs, traditional assets like long-term US bonds and treasuries may no longer provide the protection they once did. Retirees holding these instruments could see their real purchasing power decline steadily. But it's not just about central banks. Ordinary investors need to recognize that physical gold is becoming critical in preserving wealth. If you're relying solely on bonds or fiat currency, you're exposed. Even a small allocation to gold can protect your portfolio from the slow but persistent erosion of currency value. So here's a simple takeaway. Watch gold closely. Pay attention to how central banks are increasing their holdings and understand that treasuries are no longer the default safe asset. Gold is reclaiming its place as the cornerstone of financial security. Before we move deeper into the global dynamics, let me ask you, are you holding enough gold in your portfolio? If not, it's time to start thinking seriously about your allocations. And while you're at it, make sure to hit that like button if this information is helping you see the market more clearly. Let's dive deeper into why gold is overtaking US treasuries and what that means for investors. When the US prints dollars and treasuries to buy commodities or fund spending, it effectively dilutes the value of those assets. That means foreign nations and investors can no longer safely store wealth in treasuries. They need an alternative. Gold is the only reliable option, maintaining real value over time. Unlike bonds, gold doesn't depend on a government to pay interest or maintain credibility. It exists outside the system, making it ideal during periods of monetary stress. Central banks worldwide are increasing gold purchases, not just for diversification, but as a deliberate hedge against currency risk. China, for instance, is expanding gold vaults in Hong Kong, Riyadh, and other strategic locations. They're preparing for a scenario where the dollar's purchasing power declines sharply. This subtle but critical shift signals the early stages of a modern Bretton Woods system, focused on gold-backed currencies. For everyday investors, the implications are significant. Central bank demand drives gold prices higher, and commodity markets, far larger than the gold spot market, add additional upward pressure. At the same time, traditional US bonds may no longer reliably hedge inflation. Retirees holding long-term bonds could see a real decline in purchasing power, even if interest payments look stable on paper. Here's the math. If inflation is around 8% and your bond yields 4% annually, you're effectively losing 4% each year. Over a decade, that can drastically cut your wealth. Physical gold, on the other hand, preserves value and acts as a hedge against inflation and systemic currency risks. Diversification is crucial. Some investors are drawn to Bitcoin, but its volatility makes it risky for retirees or anyone seeking stable wealth preservation. A practical allocation could be 80% gold, 1-2% Bitcoin, and the rest in liquid assets. The focus should remain on physical gold, metal you can hold, store safely, and trust during financial turbulence. This shift isn't hypothetical. It's happening now. Gold's share of global FX reserves has surpassed US treasuries for the first time in decades. Central bank purchases continue, commodity inflation pushes prices up, and the dollar's dominance is slowly being challenged. Investors who don't act now risk being left behind. Let's dive deeper into why gold is overtaking US treasuries and what that means for investors. When the US prints dollars and treasuries to buy commodities or fund spending, it effectively dilutes the value of those assets. That means foreign nations and investors can no longer safely store wealth in treasuries. They need an alternative. Gold is the only reliable option, maintaining real value over time. Unlike bonds, gold doesn't depend on a government to pay interest or maintain credibility. It exists outside the system, making it ideal during periods of monetary stress. Central banks worldwide are increasing gold purchases, not just for diversification, but as a deliberate hedge against currency risk. China, for instance, is expanding gold vaults in Hong Kong, Riyadh, and other strategic locations. They're preparing for a scenario where the dollar's purchasing power declines sharply. This subtle but critical shift signals the early stages of a modern Bretton Woods system focused on gold-backed currencies. For everyday investors, the implications are significant. Central bank demand drives gold prices higher, and commodity markets, far larger than the gold spot market, add additional upward pressure. At the same time, traditional US bonds may no longer reliably hedge inflation. Retirees holding long-term bonds could see a real decline in purchasing power, even if interest payments look stable on paper. Here's the math. If inflation is around 8% and your bond yields 4% annually, you're effectively losing 4% each year. Over a decade, that can drastically cut your wealth. Physical gold, on the other hand, preserves value and acts as a hedge against inflation and systemic currency risks. Diversification is crucial. Some investors are drawn to Bitcoin, but its volatility makes it risky for retirees or anyone seeking stable wealth preservation. A practical allocation could be 80% gold, 1-2% Bitcoin, and the rest in liquid assets. The focus should remain on physical gold, metal you can hold, store safely, and trust during financial turbulence. This shift isn't hypothetical, it's happening now. Gold's share of global FX reserves has surpassed US treasuries for the first time in decades. Central bank purchases continue, commodity inflation pushes prices up, and the dollar's dominance is slowly being challenged. Investors who don't act now risk being left behind. Next, we'll examine how gold and silver are outperforming traditional investments, what COMEX data shows about market behavior, and why ETF and bullion exposure is just a fraction of what's needed to protect wealth. Now, let's focus on how gold and silver are behaving in the markets and why this trend matters for serious investors. Despite the pressure from mainstream financial institutions, gold and silver continue to outperform most traditional investments, including the 7 tech stocks that dominated portfolios over the last decade. The reason is simple. Physical precious metals are scarce, tangible, and immune to manipulation of fiat currencies. Look at COMEX data from recent weeks. Open interest in gold contracts dipped slightly during a shakeout, but the market quickly recovered. Thousands of old bulls returned, showing that serious investors recognize the intrinsic value of metals. Unlike speculative assets, gold and silver aren't bought by neighbors. These are informed, global participants, including central banks, hedge funds, and experienced bullion investors. ETF exposure is low, roughly 0.5% of total portfolios. That's tiny compared to the potential demand for physical metal. Increasing your allocation even by 1% would require the acquisition of tens of thousands of tons of gold. This is why the current rally in precious metals is so powerful. Supply is limited, but demand is growing across the globe. Industrial demand adds another layer of security for silver. While gold is largely a store of value, silver has unmatched industrial applications: electronics, solar panels, medical devices, and more. These uses are growing, especially with the global push toward green technologies. That means silver isn't just money, it's a dual-purpose asset that commands value in both industrial and monetary sectors. Let's talk about volatility. Many investors fear short-term swings, but history shows that temporary drops don't undermine long-term trends. The 1975 gold market, for example, fell by half in 9 months yet continued its long-term bull market. Volatility isn't the enemy. Lack of preparation is. Understanding trends, not noise, is key. Central banks are also influencing the market. China, India, Brazil, and other nations are accumulating gold aggressively. Their goal is twofold: protect national wealth and reduce reliance on the US dollar. This coordinated accumulation is creating a subtle but powerful shift in global financial power. Over the next 18 to 24 months, expect gold and silver to see increased upward pressure as these policies take effect. Meanwhile, the average investor is still underexposed. Most portfolios overweight tech or cash, leaving precious metals underrepresented. That's why now is the ideal time to adjust allocations. Even modest purchases can position you ahead of institutional moves. Physical metals should be prioritized over ETFs where possible, because holding actual gold or silver provides security in a system increasingly dominated by digital claims and fiat currency risks. Finally, let's address the mental aspect. Precious metals require patience. Market noise, short-term corrections, and paper trading fluctuations can create anxiety, but long-term trends matter far more. Investors who focus on real assets, understand global flows, and position themselves for both scarcity and industrial demand are the ones who will prosper. Now let's dive deeper into the global factors shaping the future of gold and silver. The monetary landscape is shifting. For decades, the US dollar dominated as the world's reserve currency, backed largely by trust in US treasuries. That trust is eroding as central banks around the world recognize the limitations of holding paper assets in a system where the US prints both currency and debt to buy commodities. This has created an environment where gold is increasingly the preferred store of value. Central banks are no longer passive. Countries like China, India, and Brazil are actively accumulating gold to diversify reserves away from the dollar. China, for instance, is setting up gold vaulting centers in Hong Kong and Riyadh and planning gold to yuan exchange facilities across Asia, BRICS nations, and the Shanghai Cooperation Organization. These efforts point towards a new global monetary system where gold underpins trade and stabilizes currencies against the declining purchasing power of fiat money. For investors, this is crucial. If gold continues to replace treasuries as a reserve asset, the price is likely to experience sustained upward pressure. Silver, due to its dual role as both an industrial metal and a monetary asset, will follow closely. The scarcity of high-grade silver deposits, most silver being a byproduct of mining other metals, compounds this effect. As global demand increases and supply remains constrained, the price dynamics for silver could become extreme. Industrial demand is only going to grow. Renewable energy, electric vehicles, electronics, and medical applications are driving consistent consumption of silver. Unlike gold, which is largely hoarded, silver is actively used, making its scarcity even more relevant. When central banks and industrial demand collide, the market will face intense pressure, pushing both metals higher. Meanwhile, the fiat currency system is showing cracks. Inflation, monetary expansion, and fiscal deficits are reducing confidence in traditional assets. Long-term bonds are now risky, yielding less than the actual loss in purchasing power. For retirees and conservative investors, holding gold and silver is becoming a necessity. Even a small allocation to physical metal can act as an insurance policy against systemic risk. Let's not forget market psychology. Many investors are still underexposed to precious metals. ETFs cover only a fraction of actual demand. To increase exposure by even 1%, institutional investors must acquire tens of thousands of tons of gold. This imbalance between demand and supply ensures that price appreciation is not only likely but inevitable in the next few years. This is also a lesson in patience. Market corrections are normal. They are part of the journey. The 1975 gold market drop didn't stop the bull market, nor will short-term dips derail the long-term trend today. Investors who react emotionally to paper losses risk missing out on exponential gains. Now, as we wrap up this deep dive, let's focus on how you, as an investor, can strategically position yourself for the changes ahead in gold and silver. The global trend is clear. Fiat currencies are weakening, central banks are accumulating gold, and industrial demand for silver is surging. Your approach must reflect both monetary and industrial realities. First, diversification is key. Gold remains the ultimate store of value, particularly during times of monetary instability. Allocating a significant portion of your portfolio to physical gold provides security against inflation and currency depreciation. Silver, meanwhile, is uniquely positioned. It's more affordable than gold and benefits from both industrial demand and potential monetary recognition. Consider a balanced allocation that reflects these dual roles, keeping in mind that the silver market is smaller and more susceptible to supply constraints. Next, think long-term. Short-term volatility is inevitable. Market dips are not failures, they're opportunities. History shows us that temporary declines in gold or silver prices do not derail the long-term bull trend. For example, brief market corrections in the 1970s or recent COMEX shakeouts had little impact on the metal's trajectory. Patience and strategic accumulation are essential. Keep liquidity in mind. While gold and silver should form the backbone of your portfolio, maintaining access to cash or short-term instruments is critical for seizing opportunities as they arise. Avoid over-leveraging or speculative exposure that could jeopardize your core holdings. Watch international developments closely. China's gold-backed yuan strategy, BRICS trading alliances, and gold vaulting expansions in Asia and the Middle East indicate a slow but steady reorganization of global finance. The G7 currencies may weaken further, making gold and silver more attractive not just as commodities, but as currencies in their own right. These geopolitical shifts will influence market pricing, so remain informed and adaptive. Finally, stay engaged with community insights. Monitoring ETFs, bullion flows, and industrial demand gives you a pulse on market trends. Even modest exposure shifts in institutional holdings can dramatically impact prices due to the relatively small size of the physical silver market. Understanding these dynamics helps you make informed decisions rather than reacting emotionally. That brings us to the close of today's analysis. If you found this breakdown useful, hit the like button, share with fellow investors, and subscribe to Gold Rush Reporter for daily insights on gold, silver, and market dynamics. Tap the bell icon to ensure you don't miss updates, particularly when market trends accelerate or critical developments occur. Remember, vigilance and preparation are your allies. Accumulate wisely, diversify thoughtfully, and always be aware of both industrial and monetary forces at play. Gold and silver are not just investments. They are insurance against financial instability and instruments of strategic wealth preservation. Thank you for joining me today. I'm Conrad, your gold and silver analyst at Gold Rush Reporter, helping you navigate the evolving landscape of precious metals. Stay sharp, stay informed, and keep stacking.